Welcome back to this fifth video. In this series, we're learning to build out a company and follow it through a series of transactions. In this video specifically, we're going to take a look at how you purchase inventory on credit, which means we're not going to be paying for that inventory with cash. In addition to that, we're going to learn how to calculate the cost per unit. So when we actually go to sell this inventory later in this series, we'll know how to correctly record the cost of sale. All right, if you haven't seen the previous videos, make sure you go back and watch those. In the very first video, I show you where to download the workbook for this course, as well as how to use it. And you're going to need this workbook in order to follow along with this course and to follow along with the build out. Lastly, if you haven't hit the button yet, make sure you click it and become a student of this channel and hit the notification bell to be notified when I post new content. All right, let's get into this video. All right, I'm in my computer screen now and I will zoom in so we can read this together. There we go. All right, so now we're jumping forward all the way to October 1st, 2020, okay? October 1st, 2020. Partnering with a local manufacturer named We Build Incorporated, you purchase and physically receive your first line of unique coffee mugs with the slogan, Be Happy. You buy 50,000 mugs at 50 cents per mug. The manufacturer has agreed to extend you credit with terms 210 net 30, and you decide to make payment on this at the end of 30 days. Okay, let's talk about what's happening. If you remember, we're building a company that's going to sell coffee mugs. We're now at the point of the business where we're actually going to purchase our first set of inventory in order to sell in the business. Okay, so we're going to buy 50,000 mugs at 50 cents per mug, and we're not going to pay for cash this time. The vendor that we're working with has extended us terms. And a lot of times, this is very common in business where on the very face of an invoice, the vendor might extend some terms. Sometimes they'll say, no way, you got to pay up front or you got to pay upon delivery. In this case, the manufacturer, because of our relationship, is willing to extend us terms like a credit card in a sense. So they're going to ship us that inventory on October 1st, but according to their terms, 210 net 30, that means you can either pay before the 30, you can pay within 10 days and receive a 2% discount, or you just pay the entire balance in 30 days. That's what 210 net 30 means. In our case, we're going to take the full 30 days. So we're not going to pay for the inventory in this video. We'll pay for that in a later video, but we are going to record the purchase of the inventory and the liability, the promise to pay it back. So let's take a look at what that looks like. So the first thing is, let's put in our post date. This is October 1, 2020. And the account we're going to want to use is, we can scroll down here, and the options that I've created for us really is just inventory. So we're just going to book inventory in this case. We'll put a memo in here. We'll say, I don't know, 50,000 mugs, happy mugs, I think what did I put? Be happy. Oh, so I'll say be happy. Be happy. And let's see, 50,000 mugs, be happy. That's probably good enough for now. And now, okay, let's say, is this a debit or credit? Well, inventory is an asset because we expect to get a future benefit. So it's a benefit to us. So we are going to record that as, anytime you have an asset that increases, it's going to be a debit. So we're going to record, and I'm just going to do formula based. You could just plug it in, but I'm just going to go 50,000 times the 50 cent per mug. That gets us, so it's the value, the cost of these mugs is $25,000. We got $25,000 of value of inventory at cost. So now we need to record the offset. And if we just look together at our general ledger tab, we have an asset, but we owe something. And anytime we owe something, we have what's called a liability. So let's just take a look at the liability accounts that I've made available for this course. We have accounts payable, accrued expense, accrued payroll, and notes payable. So anytime you're dealing with inventory, probably 100% of the time, it's always going to be categorized as an accounts payable. So we're going to use this accounts payable account. And that's pretty standard. Anytime you're dealing with some sort of goods or services, the vendor sends you their invoice. You take that invoice, you record it as an accounts payable, and then we'll pay that later. And we will pay this later in this course. So the account we want to do, we're going to go ahead and put the post date. We'll go to account name. We'll go to account and scroll down till we see accounts payable. I'll put in the same memo, and we now have a liability account. And just for a refresher, when we have a liability that increases, it's going to be a credit. So we have at this point a zero balance in our AP account, our accounts payable account, and now we have a $25,000 balance in that account. So it's increased, and a liability account like this, when it increases, is going to be a credit. So we'll go to our journal entry. We'll complete this journal entry by balancing it out and record $25,000 to our accounts payable journal entry. All right, so now let's follow that through the general ledger. So here we go. If we look at our inventory account, we now have a debit balance of $25,000. If we go down to our accounts payable account, we now have a credit of $25,000. Follow it to the income statement. No activity yet, because inventory is kind of similar to fixed assets and prepaid assets. When you're doing accrual accounting, you don't recognize cost until you actually incur the cost. So like a fixed asset or a prepaid, when you would recognize that expense when you benefit from that. In inventory, you're going to recognize it when you incur it. And in this case, you only recognize the cost of inventory when you actually sell it. So we will look at that later in this course. So no activity on our income statement yet. Let's go to our balance sheet now. And you'll notice, if we look at total assets right away, you'll notice that total assets has increased from 150,000 from the last video now to 175,000. That's because we made a purchase of inventory, but we didn't pay for it with cash. We got it on terms. So you'll see the offset of this is down here in our accounts payable. So our liabilities and shareholders' equity now has equally increased to 175,000, which equals our basic accounting equation: assets equals liabilities and equity. Now the last part of this is we have two balance sheet accounts, right? We have two accounts that are being held on the balance sheet that have changed, and therefore we need to update those schedules so that we can track these transactions, as well as make sure that we do a proper close at the end of this year. So let's go first to inventory. Scroll over till you see the inventory schedule account, and let's go ahead and fill this out. Now SKU, you can just make this up. I'll just say the SKU number, that's the SKU number. The SKU name, I'll just say, be happy. The transaction type, well, this is inventory that we've received, and I'll put the transaction date. We received this on 10/1/2020. Quantity 50,000, and our standard cost is going to be the cost per unit in this specific case. So we'll say 50 cents, and our extended cost is the quantity times the standard cost. That is our extended cost in accounting. So now we've filled out our inventory schedule. We know what our cost per unit is for tracking. And now let's fill out the other side of this entry, which is our accounts payable. We need to track this invoice because we haven't paid for it yet. So we need to make sure that we are tracking it in our inventory system so that we can later pay it when it's due. And so we maintain a good relationship with the vendor. If you pay it after it's due, you're going to hurt your relationship with your vendor. And a lot of times, if you're late for paying for invoices past the terms date, a lot of times vendors will take those terms away from you, and they'll change the relationship of your business and say, hey, you're paying late, we can't extend you terms anymore. You need to prepay before we ship you anything. So it's super important to track your invoices and to pay it on time. So let's go here and fill this out. Now let's see, I don't remember what was the vendor's name we used. We Build Incorporated. Okay. We'll go vendor. We Build Incorporated invoice. Just make something up. Invoice number 100, date 10/1/2020, memo. Purchased 50K Be Happy mugs. Type of the transaction, this is an invoice, and the amount, I'm going to record it as a credit here. I'm going to record the amount we still owe this company is $25,000. Okay, so that's it. That's the end of the video. We took a look at how you purchase inventory, how you handle that transaction when you purchase it on terms. We followed that through the general ledger and how that impacts our financial statements, specifically our balance sheet account, and we're looking at how we actually track that in schedules. All right, I hope you enjoyed the video, and I look forward to seeing you in the next video. All right, thank you. Bye.